A man forgot his wallet at a fancy restaurant in 1949. To avoid washing dishes, he convinced his wife to pick him up and pay the bill. That embarrassing moment sparked an idea that would transform consumer finance forever. A simple piece of cardboard would eventually put trillions of dollars of debt in people's pockets and make banks richer than any industry in history. Welcome to Money Stories, where we uncover the hidden histories of finance and expose how everyday innovations become world-changing systems. Today, we're exploring the birth of the credit card, a story that begins with embarrassment and ends with a profound reshaping of consumer finance. Frank McNamara was a successful businessman. In New York in 1949, he was educated, wealthy by the standards of the time, and accustomed to fine dining. On an evening in February 1949, McNamara took clients to Major's Cab and Grill, an upscale restaurant in Manhattan. The dinner was excellent. The conversation was productive. But when the check arrived, McNamara reached for his wallet and realized he'd left it at home. The embarrassment was acute. McNamara was a man of means, yet he couldn't pay for his own dinner. His wife had to come to the restaurant with money to settle the bill. The experience haunted McNamara. The humiliation of not being able to pay burned in his memory. But as he reflected on the incident, McNamara recognized something important. He wasn't poor. He simply hadn't brought his wallet. What if there was a system that allowed him to establish his creditworthiness without carrying cash? What if he could present a card that proved his ability to pay and settle the bill later? McNamara discussed the idea with his friend Ralph Schneider. Schneider was enthusiastic. Together, they conceived of the Diners Club card, a simple cardboard card that would serve as proof of creditworthiness. The card was issued to select individuals who had demonstrated financial stability and reliability. Restaurants that accepted the card agreed to extend credit to cardholders. Knowing that the Diners Club would guarantee payment, the first Diners Club cards were issued in February 1952. Roughly 200 people. The cards were literally cardboard, printed with the cardholder's name and a serial number. There was no security feature, no hologram, no magnetic stripe, just cardboard with some information written on it. Yet the system worked. Restaurants that accepted the card trusted the Diners Club to verify that cardholders were creditworthy and to guarantee payment. The business model was elegant. Diners Club charged cardholders a membership fee, roughly $1 to $3 annually, a significant amount in 1950. Diners Club also charged restaurants a commission on each transaction, roughly 5 to 7% of the bill. This meant that a cardholder spending $50 at dinner would cost the restaurant $2.50 to $3.50 in commission. To Diners Club, the restaurant accepted this cost because it attracted wealthy customers who might spend more than Cochoni diners. Diners Club captured value from both sides of the transaction. The card spread rapidly. By 1951, Diners Club had roughly 50,000 cardholders. By 1960, it had roughly 1 million. The card was increasingly accepted at restaurants, hotels, airlines, and other merchants. The cardboard was eventually replaced with plastic in the late 1950s, but the fundamental system remained unchanged. Other companies quickly recognized the opportunity. Bank of America created the Bank Americard in 1958, which eventually became Visa. MasterCharge, now MasterCard, was created in 1966. These companies realized that Diners Club's model could be massively scaled. Rather than limiting cards to wealthy individuals, banks could issue cards to millions of people. The interest rates charged on outstanding balances would be far more profitable than membership fees. The transformation from Diners Club to modern credit cards marked a fundamental shift in consumer finance. The original Diners Club card was designed for wealthy people who paid their bills in full each month. The card was a convenience, a way to avoid carrying cash, not a mechanism for borrowing money. But when banks entered the business, the model changed dramatically. Banks issued cards not just to wealthy individuals, but to ordinary people with varying abilities to repay. Banks charged interest rates on outstanding balances, rates that could exceed 20% annually. The credit card became a powerful tool for consumer lending. Rather than people saving money and then spending it, people could now spend money they didn't have and repay it with interest over time. Banks profited enormously. A cardholder who carried a $1,000 balance at 20% interest would pay $200 annually in interest alone. Over a lifetime, a typical cardholder might pay tens of thousands of dollars in interest. The psychology of credit cards was carefully engineered. The cards were small enough to fit in a wallet, easy to use, just hand it to a merchant, no negotiation required, no visible reminder of how much was being spent. Unlike cash, which physically depletes as you spend it, credit cards create no sense of depletion. Spending with a credit card doesn't feel like spending money. This psychological separation between action and consequence made people spend more freely. Credit card companies increasingly targeted people across income brackets. Those with lower incomes and less financial education were often the ones who carried balances and paid interest. Credit card companies sent pre-approved applications to millions of people. They encouraged spending through advertising that emphasized the ease and freedom of using cards. They structured minimum payments so low that people could carry balances for years, paying substantial interest while making slow progress toward repayment. By the 1980s, credit card debt had become integral to the American economy. People financed cars with credit, financed education with credit, financed consumption with credit. The entire consumer consumer economy came to depend on people's willingness to borrow and carry debt. Credit card companies became extraordinarily profitable. The interest and fees charged to cardholders generated enormous revenue streams. The credit card system created a complex incentive structure. Credit card companies profited more when cardholders carried balances and paid interest. If everyone paid their bills in full each month, credit card companies would collect only transaction fees for merchants. But if cardholders carried balances and paid interest, credit card companies could extract significantly more value. This gave credit card companies incentives to encourage borrowing, to make debt easy to incur, and to make minimum payments accessible but inefficient for debt reduction. The system also captured behavioral economics insights that made spending psychologically attractive. Credit card companies offered rewards programs that made spending feel valuable. They offered cashback and airline miles, creating the perception that spending was rewarding. They offered promotional interest rates for introductory periods, encouraging people to transfer or carry balances at seemingly low rates. When the promotional period ended, rates would jump to 20% or higher. By then, many were already committed to the debt. The credit card system enabled immediate consumption but required payment from future earnings. A person who borrowed $10,000 at 20% interest would spend years repaying. During that time, they would pay roughly $2,000 annually in interest, essentially transferring money from their future earning power to the credit card company. Multiply this across hundreds of millions of cardholders, and the transfer of wealth from ordinary people to credit card companies becomes staggering. The credit card industry became one of the most profitable sectors in America. Banks that issued credit cards earned returns on equity exceeding 20%, far higher than most other industries. The profitability came directly from the business model. The spread between what banks paid to borrow money and what consumers paid in interest on their credit card debt. The system worked beautifully for banks, but created financial challenges for consumers who didn't manage their credit wisely. By the 2000s, credit card debt in America exceeded $800 billion. By 2024, it exceeded $1 trillion. Americans were collectively carrying debt that would take years to repay, paying high interest rates, and in many cases, struggling financially as a result. The cardboard card that started as a solution to a man's embarrassment had become a cornerstone of consumer finance on a scale that would have seemed impossible in 1950. The credit card system became so pervasive that it fundamentally changed our relationship with money. People accepted that carrying credit card debt was normal, that paying double-digit interest was part of modern life, that spending money they didn't have was standard consumer behavior. What started as an embarrassing moment at a restaurant in 1949 had become the foundation of a system that facilitated trillions in consumer spending and debt. Frank McNamara's embarrassment created something far beyond what he intended, not just a solution to forgotten wallets, but a system that revolutionized how people interact with money. The cardboard became plastic, the system became digital, the mechanisms became more sophisticated, but the fundamental principle remained unchanged. Provide immediate purchasing power now, in exchange for payment later with a premium. That's the story of how a forgotten wallet created the credit card industry, and how that industry became one of the most powerful forces in consumer finance. If you found this history of financial innovation compelling, subscribe to Money Stories for more uncovered truths about the systems that shape our economic lives. Leave a comment below. Do you think credit cards have been a net positive or negative for society? Thanks for watching Money Stories, and I'll see you in the next episode.